Ronald, thank you so much for your time again today. Today, I wanted to ask you about the tax that kind of went under the spotlight, the Underused Housing Tax Act. I think this was part of the 2021 federal budget. Just to give a quick summary, the government of Canada announced its intention to implement a national 1% annual tax on the value of residential real estate owned by any non-resident, non-Canadian that is considered vacant or underused. Because I think there's a City of Toronto one kind of affected everyone, like you said. So, can you give us a brief overview and maybe the purpose of this federal tax?
Sure, absolutely. So, like you said, this is basically a new tax, 1% about of the approximate value of the property. It's meant to cover essentially people who are either non-Canadian citizens or non-permanent residents, and it's on vacant, underused residential properties specifically. And it covers direct or indirect ownership by anyone who is not, again, not a permanent resident or non-Canadian
Okay.
citizen.
Okay. So it really only affects non-residents and non-citizens.
Yeah. Essentially, if you're a Canadian citizen or you're a permanent resident, you largely do not have to worry about this tax, except in very narrow circumstances where you may be, for example, owning certain properties in partnership with other people who might not be Canadian citizens or permanent
Okay.
residents.
Okay. So I guess a foreign buyer's ban is the issue that we spoke about last time in the last video, and this is something on top of that. So number one, they're banning all buyers for 2 years, foreign
Hmm.
buyers, and this will be if you're a foreign owner already that owns property here, then you get hit with this tax.
Essentially, yes.
Okay. Okay. Um, I guess does this apply to all residential properties?
So it applies to most common residential properties. So again, things like detached homes, duplexes, triplexes, laneway houses, cottages, semis, condo units, everything like that. There are properties that are considered commercial, even though that they are often used for residential purposes. This would be basically buildings that have 4 dwelling units or more, high-rise apartment buildings, buildings that are split kind of like commercial and residential, but more than 50% of it is for retail or office use. Those are not considered residential
I see.
properties.
I see. Okay. Are any owners excluded from paying the UHT?
So the owners that are excluded again are if you're a Canadian citizen, you're a permanent resident, it's just not applicable to you. Other than that, there can be cases where you are. It is like if you're not a Canadian citizen, you're not a permanent resident, you still have to file a return, but it may not be applicable. Like the tax may not be payable in certain circumstances. So how that kind of works is it depends on the property and how the property is used. Again, because the act is largely catered towards underused or vacant properties. If the property is largely in use, like it's rented out, then you still have to file a return, but you will not have to pay the tax.
Right. Right. Okay.
Yeah.
Okay.
So there's a whole bunch of different exemptions, like if the properties are vacation properties, they're used as primary place of residence for family members who might be Canadian citizens or permanent residents. There's a whole bunch of exemptions where you might still have to file a return, but the tax won't be payable. So if you have any specific questions about your situation, it's recommended that you either contact a lawyer who can kind of give a little bit more advice on the specific exemption that might be available. The federal government also has a program where you can essentially inquire about what your specific situation is based on like your fact scenario, given that this is like a very new law and it is very confusing for a lot of people under the different exemptions.
Absolutely. Okay. Sounds good. Well, I guess you touched on this before about the difference between this law and the City of Toronto home tax. So is this UHT, is it applied in addition to the City of Toronto vacancy tax then?
Yeah, so it absolutely is applicable separate from any kind of provincial or like municipal legislation with respect to those additional taxes. So there are certain situations in which both of those could be payable. Again, if you're a non-resident and you're not a Canadian citizen and your property is largely vacant or underused, then both of those taxes would apply.
Okay. Yeah. And how is this UHT going to be administered? Like, when is the deadline to file, and how is the government of Canada? What are their plans to administer this program?
So basically, the due date to file a return is for any given year. So this year is the first year that it's going to be considered. So the due date usually is April 30th of the following calendar year.
Okay.
So for example, any property that's owned December 31st, 2022 of this year, you would have to file by April 30th of 2023 next year. You also have to pay the UHT by that deadline.
Okay.
So it's not really a situation where you file a return and then you can worry about the tax later.
Yep.
The tax amount has to be paid by that deadline as well. In addition, beyond filing, especially if you're claiming some sort of exemption so that you don't have to pay the tax, that kind of thing, you have to maintain all records regarding any individual filing year for at least 6 years from the year that they're filed. So
Okay.
let's say you're claiming, you're a non-resident, you're non-Canadian citizen, but you're claiming that this property is rented out under like a legitimate lease to, like a tenant. You have to keep records of all of those documents that you're claiming the exemption under.
Okay. Okay. Perfect. How's the UHT calculated?
So the UHT is calculated based on 1% of the taxable value of the property.
Okay.
So this one is a little bit more complicated than the City of Toronto vacant home tax. That one is just based on whatever your property was assessed at.
Yeah.
This one is the greater of either what your property was assessed at. So again, the MPAC assessment, which is the one that's used to pay property taxes, or B, the property's most recent sale price on or before December 31st of the calendar year.
Oh, wow. Okay.
So basically, if you had purchased the property relatively recently, and that value, the purchase price that you purchased that is, for example, substantially higher than the MPAC assessment, then you have to use the purchase price of the property of when it was purchased.
Oh, wow. So,
most recent purchase price.
So typically those are much higher than...
Yeah, that's often the case. So there is one kind of exception to that. You can elect to use what's considered the fair market value of the property at any time, on or after January 1st of the calendar year and before April 30th of the following calendar year, like again, during that filing period. If you believe that the market value of the property has, for example, fallen significantly since when it was purchased, you can elect to use that. But if you choose to use that, there needs to be like a valid appraisal report, written appraisal, or for example, like a signed letter of opinion that has to be. The CRA can request a copy of that. So you basically have to be able to kind of show why you believe that the market value of the property is lower than what the sale price was.
I see. Okay. And what kind of penalties are people looking at for failing to file or not not following the instructions of this tax?
Yeah, the penalties are quite significant for failing to file. So the CRA has instated minimum penalties. Basically, the minimum penalty for failing to file by the deadline is $5,000 for an individual. For anything other than an individual, so for example, corporations or anything like that, the minimum penalty is $10,000.
Okay.
The maximum penalty is basically calculated as a percentage of the tax. So it's 5% of the tax that's payable plus 3% of the tax that's payable.
Wow.
For each month that the return is not filed. So
for each month.
Exactly. Wow. So if you delay filing for a long period of time, that amount can really add up. In addition, if you fail to file the return by December 31st of the following calendar year that you're supposed to file. So for example, like in the 2020 year, if you don't file at all in 2023, the maximum amount of the penalty is calculated as if there are no exemptions.
Oh, wow.
So basically, if you don't file like in that year, like if your filing is too late, they do not even consider if you are applying for certain exemptions under
so
they'll
just penalize you no matter. Okay.
Essentially, yeah.
Okay.
So it'll be the amount that you have to pay is the tax that should have originally been payable plus these
the
additional amounts.
Oh, wow. Okay. So this is another item that's added on by the government to kind of complicate things and make things a little bit harder for I guess filing and more bureaucracy in there.
Absolutely.
Thank you so much for your time today and for the information. If anyone has any questions, we'll leave Ronald's information in the description below. You can always email him, call him, and he'll respond. And he's very well versed in this. So thank you so much, Ronald.
Thanks, Isaac, for having me.
Thank you, everyone.
Thank you, everybody.